Let's begin with the first statement. And the first statement is income statement. Remember, as I mentioned, there are only three statements that we need to be aware of, and there are only three statements that we need to understand very well. And I'm repeating, those three statements are: number one, income statement, and number two, the balance sheet, and number three is the cash flow statement. Today we are going to cover the income statement and the balance sheet. So we would cover the cash flow statement tomorrow. Now, what is income statement and what is balance sheet? And how is the difference between the two? Before we start discussing in the nuts and bolts, let me tell you, friends, income statement, as the name suggests, what does it tell me? Income statement tells me how much is my income and how much is my expenses, how much are my expenses, and difference between the income and the expenses tells me how much is my profit or how much is my loss. So that is income statement. So it means what? It means what all items will figure in the income statement of a company, of our company, or any company for that matter. Since income statement is a statement that gives me what is my income and what are my expenses, so every item of income will appear in the income statement. Every item of expense will appear in the income statement. And difference between these two, total of these two, is either my profit or it is my loss. So if my income is more, my income is more, expenses are less, I have profit, good situation. If my income is less, expenses are more, I have loss, it is a bad situation. So that is the basic understanding of the income statement. What about the balance sheet? Balance sheet is a statement that tells me what are my assets and what are my liabilities. What are my assets? What are my liabilities? Meaning what? Meaning what will appear in a balance sheet? In a balance sheet, all the items of assets of a company will appear in the balance sheet on one side, and all the items of liabilities will appear in the balance sheet on the other side. So what is my balance sheet tells me? My balance sheet tells me as to what are my assets and what are my liabilities, right? So that is your balance sheet. So what balance sheet tells me in general? Balance sheet gives me an idea about the financial position of a company, of the company. So if a company has got more loans and less equity, it is a bad sign. But if a company has got more equity and less loans, it is a good sign. So that is how we will figure out as to how good or bad balance sheet of a company is. So please remember, let me.
Sir, request to repeat that relation between that equities and loans that
Perfect,
you said
perfect,
also.
perfect. So remember, equity means what? Uh, all of you, how does a business start? Anywhere in the world, whenever someone is starting a business, he starts that business with capital. And remember, this capital can come from two sources. Source number one is equity. And what is the meaning of equity? Meaning of equity is money which is put in by the promoters of a company, of a business, into the business is equity. And
Sorry, Mahajan, we lost your voice. You have said that we have two sources. The source number one, we are not able to hear.
okay, uh, okay, is it with everyone or only with some of you?
No, it's with me also, sir. We lost you.
Everyone.
Yeah, all of us.
Okay, no worries, no worries.
Now it is clear, sir.
Okay, thank you.
Sir, one thing you can do, we can switch off your video so that we can get the better bandwidth.
Okay, that's I think even better. Yeah, that's a good idea. Is it okay now?
Sir, better.
That's a very good thought. That's a very good thought. Okay.
Yeah, I think so, Pramod.
Is it better now, Ian? Hello.
Yes, it's now better. Yeah, we can hear you now clearly.
Okay. Thank you, Ian. Thank you. Thank you. So there are two sources for starting business anywhere in the world. Which are the two sources? The first source is money which is put in by the owner of the business into the business. And this is known as equity. This is known as equity. And remember, when you start a new business and when the business is growing, a growing business will need more capital. A growing business will need more capital. So, where does this additional capital come from? This additional capital, friends, will come from the debt. Because as an owner, as a promoter of a company, his resources are going to be limited. So he can fund the operations, he can fund the business from his own capital up to a point. After a point, he will need to borrow money from outside. So that is the second source. So when I said if a company has got more debt and less equity, it is a bad sign. And why it is a bad sign? Remember, when you have more debt in the business, it means what? It means you have more interest to pay.
Interest to pay.
Yeah, so you have a more interest to pay. Since you have more interest to pay, that means you have a fixed interest payment obligation. And that means what? That means if for some reason, if your company's operations are not doing well, you're not making enough profit, you may not have enough cash in the business to pay that interest or to repay that loan. And that means what? That means those lenders who have given you capital can file a complaint against your company or file an application for bankruptcy of your company. And that is the reason I say that if debt is more, equity is less, it is not a good balance sheet. But equity is more, debt is less, that is considered to be a good balance sheet. I hope that answers your query.